Hello everyone, in this lecture we will be talking about investing and trying to evaluate market efficiency. So our agenda is the following. First, I will again try to motivate today's lecture a bit by backtracking and talking about the assumptions we made under the CAPM, and then try to present to you some empirical methodologies to evaluate the assumptions of CAPM. In doing so, we have to talk about some institutional details about how to actually go about investing in the market portfolio, and we typically go about doing this through investing in mutual funds, okay? And I will be talking about two types of mutual funds, specifically actively managed funds and also index funds. Second, I will also talk about alpha and market efficiency. So if you recall a few weeks ago when we presented the CAPM to you, we have an additional term when we estimate the CAPM using regression analysis. And this term is the alpha. The alpha is supposed to capture additional returns above and beyond or below what's predicted by the markets. And we're going to try to evaluate what alpha actually looks like from the perspective of portfolio managers and also from constructing portfolios ourselves. And lastly, we will try to expand the CAPM using additional risk factors. And we'll be talking about up to three additional factors that the finance literature has attempted to augment the CAPM. All right, so let's just get started. So let's review a bit. So the CAPM and the portfolio theory basically makes the following assumptions. We assume that investors are risk averse, and therefore they should optimize their portfolios by minimizing risk and by maximizing returns. And in doing so, investors essentially will be holding the tangent portfolio, right? The portfolio that is the most risk efficient when given also the risk-free asset, right? And so under the assumptions of CAPM, which I will review here, so let's go over that right now. But once we have the CAPM assumptions, we have the final conclusion, which is the tangent portfolio is simply the market portfolio. And we then subsequently ask ourselves three additional questions. How do we actually go about investing in the market portfolio? What does the CAPM have to say about beating the market? And lastly, if the CAPM is too strict, is there a way to extend the CAPM with additional risk factors? And we'll go through that one by one. So first, let's review a bit by reviewing the assumptions of CAPM. So firstly, for CAPM, we have to assume that number one, investors can buy and sell at competitive prices. Buy and sell assets at competitive prices. So again, what that means is that there's no restrictions to shorting or going long on a specific asset, and an individual can buy unlimited amounts of that. So essentially, there's very little frictions in the markets, and there's always a supply if you want to buy a particular asset, and there's always someone willing to buy it if you're planning on selling an asset. Number two, we also have to assume that investors hold risk-efficient portfolios. In other words, we have to assume certain preference structure of investors. So assuming investors dislike risk but like returns, higher returns, then we can assume that they will approach their portfolios by finding the right trade-off according to their utility function. And in doing so, they will be holding risk-efficient portfolios. So investors all hold efficient portfolios. So I'm going to write risk-efficient portfolios. And lastly, and most importantly, we are assuming that investors have the same information set. Or in other words, investors all agree on the mean return of an asset, the variance of an asset, and the covariance structure of all assets in the universe. So I'm going to write investors all agree on the expected return of an asset, of all asset I, any asset I, and its variance, and also the covariance structure between all assets. So I'm going to put commas here. and then covariance of Ri and Rj. So for any pair of assets I and j. All right, so it's very difficult to kind of evaluate assumptions 1 and 2. We don't observe utility functions of investors, but for the most part, we can assume that on average, maybe in aggregate, there is a representative investor that behaves this way. That's fine. Number one, that really depends on microstructure and how exchanges are conducted. So we can't really evaluate that from the perspective of a corporate finance practitioner. But number 3 is definitely doable. We can actually conduct some tests to evaluate whether the information sets of all investors are the same and whether or not information that's released publicly is transmitted efficiently or instantaneously. If there's any sort of delay, then we know there is a processing cost, and that basically undermines assumption 3 and therefore could likely break the cap M. So let me put a star next to number 3, as we will be discussing ways in which number 3 can be violated and how that's going to impact our CAPM. All right, so to summarize this slide, if we assume CAPM holds, the assumptions of CAPM holds, then we must conclude that the tangent portfolio in aggregate is basically the market portfolio, because everybody's holding a piece onto the tangent portfolio, and if we aggregate supply, it must equal to demand in equilibrium, and therefore the tangent portfolio is simply the market portfolio. And our task today is to figure out institutionally how we would go about holding the market portfolio, and then also evaluate whether or not the cap M is rigorous enough, in the sense that there's no obvious violations of the assumptions we made in order to conclude that the market portfolio in fact indeed is the tangent portfolio. All right, so as I already stated, this is the agenda. So let's go ahead and start by talking about how we go and invest into the market portfolio. So in general, there's 3 ways to invest in securities. We can first, obviously, we can build our portfolios ourselves. We can buy them individually. We can pick them ourselves, and we pay somebody to actually help us, or we can actually pay somebody to buy them for us. But anyways, we can individually construct our portfolio by buying specific assets that we mentioned before. We have to weight our portfolio based on each stock's market capitalization, right? Relative to the overall market cap of the stock market. Secondly, you can also buy actively managed mutual funds. So what that means is that we can actually have a company, incorporate the company, and the whole purpose of the company is to hold portfolios of stocks. And you would buy, rather than buy individual shares yourselves, you would just buy shares of the company. So the performance of the company or the fund is linked to the share performance of the fund that you buy instead of the actual stocks themselves. Okay, so to reiterate what a mutual fund is, it's a fund that holds a portfolio of stocks, and you, rather than buy the stocks yourselves, you would own shares of the mutual fund. And the way the mutual fund earns money is by charging fees on asset under management. So the fees for mutual funds, actively managed mutual funds, meaning they don't follow any particular index, they simply have their own internal strategies, and they trade based on those strategies that they develop themselves. And they would charge a fee based on how much money they're able to collect from the market. So that's typically called asset under management, or AUM. Okay, so AUM is defined as assets under management, which is the amount of money they raise and invest in the market. And for actively managed mutual funds, they charge typically in the range of 1% to 5%. Conversely, rather than investing in these actively managed mutual funds, you can actually invest in what's called passively managed funds. So passively managed mutual funds are different than active ones, because rather than use their own ad hoc specific strategy, they simply just benchmark their portfolio to an index that's well known, such as the S&P 500 or the Hang Seng Index. Okay, so in other words, they don't have a strategy. They're simply just changing the portfolio holdings based on how the market is performing. And they therefore, because of less work, essentially their only work is to make sure their portfolio is tracking an index, they can charge lower fees. So for them, again, similarly, it's still a percentage of asset under management, but the fees is much lower. So it ranges from about 5 basis points to 30 basis points to 30 basis points. And that in percentage terms is 0.05% to 0.30% of AUM. Okay, so just to emphasize the differences between these two types of mutual funds, it's important to note that actively managed mutual funds has two ways to make money. One is to actually make superior trades, buying undervalued stock, and those stocks perform well, and also through fees, which is if they can collect increased fund flows, meaning they can attract more investors to give them money, they can charge fees and therefore collect income from that. So through superior trades and through collecting increasing fund flows, they can generate money and therefore grow the company or their fund. Conversely, passively managed funds don't have strategies, right? They don't have unique strategies. Their only strategy is to follow a specific index, which is well known and publicly known. And so their only cost is really having computers or workers make sure that the portfolio is tracking an index. So the only way they really make money, therefore, is through fund flows, right? They have to attract investors to give them money, and they use that money to, increase the size of their portfolio, okay? And therefore, they can generate more money. That's the only way, okay? So let me reiterate. They can make more money, if they can do superior trades, or they could increase fund flows, meaning getting more people to give them money to make investments on their behalf. Whereas index funds or passively managed funds, they can make money only through increasing fund flows, or find some way to automate their portfolio rebalancing so that they can track the index better at a lower cost. But anyways, those are very minor, gains and performance if you invest it that way. All right, so let's talk more about index funds. All right, so this is what you typically would use to calculate the market risk premium in your CAPM model. So we're going to rely on index funds essentially to get a sense of the average return of the overall market. So market proxy for index funds, they're basically two categories. One's like a broad enough index or just a broad index funds, and that's typically the index that tracks the top X 100, 500, 100 firms, and it's going to be value weighted, meaning it's going to be weighted by market cap. And the most popular index fund in the US is the S&P 500 index. And mutual funds, there's lots of mutual funds that track this. The first and the most popular one is obviously the US Vanguard 500 index fund. So if you have a firm that you're trying to calculate the weighted average cost of capital, you should be most likely using either the index itself or looking at the Vanguard 500 index returns as your market return, excess return. Okay, if you're looking at firms in the in Hong Kong, you should be using the Hang Seng Composite Index, and that tracks up to 300 listed firms that's listed on the Hong Kong Stock Exchange. Okay, of course you can always go broader, and in the US I think there's roughly around 3,000 to 4,000 publicly traded firms. So the US usually is called the Russell 3000, covers basically the entire universe of publicly traded firms. And the Vanguard also has a mutual fund that tracks them, and it's called the Vanguard 3000 Index Fund. I don't believe Hong Kong has a broad index because, again, Hong Kong is not as large of a stock market as the U.S.'s New York Stock Exchange and NASDAQ combined. Okay, so for your project, you should definitely just only be looking at the S&P 500 index returns. And also, if you're looking at firms being traded on Hong Kong, you should be looking at the Hang Seng Composite Index, okay? To construct your CAPM, weighted average cost of capital. Okay, so of course there are other types of index funds, and their strategies, again, is not based on, it's not idiosyncratic, it's not ad hoc, it's not based on, intuition on the markets or private information. It's based on some algorithm that's automated by computers, okay, or done systematically by manually. Other kinds of index funds are ones that track some sort of basic strategy, such as momentum funds, such as momentum trading. So momentum trading. So iShares Momentum is a mutual fund that's run by BlackRock, I believe. And what they do is they buy past winners and short past losers. All right, so let me summarize this: buy past winners and sell past losers. Okay, so of course this is automated, meaning they have a predetermined algorithm. They only look at, for example, whether or not the stock went up in the past 3 years, and they put some money in it, and they can look at past losers from the past 3 years and put some money in it, and then they calculate the overall returns, and that would be your return if you invested in that momentum fund. Okay, other types of index funds include quality. So there's many ways to evaluate quality. Some way is to look at, for example, book to market ratio. So when I say book to market, we're talking about book value of shareholder value. Book value of shareholders value. So book to market, and market value, of course, is just market cap. If you believe that a firm has good fundamentals, then book value would be quite high, and therefore you would buy firms with high book value relative to their market cap. Other factors you may look at include good governance. Some people believe that governance is like a hidden factor that's not accounted for by the market risk premium. This could be like, again, we're just thinking proxies for quality. So if you believe that, for example, having a separate individual, two different individuals to be the CEO and chairman, you might think that having two separate people holding these two positions can improve management, for example. There's less conflict of interest and therefore can improve firm value. Then this index fund therefore would buy firms with good governance and short firms with bad governance, and the return that you get on this portfolio strategy is the return you would get on this index fund if you decide to buy shares in it. Okay, so of course there are other. So the example I give you here is chairman, CEO, but you can think of other quality measures such as whether or not there's dual class shares. Some companies have two separate shares being traded in the stock market. One has voting rights, the other doesn't have voting rights. And again, this is a mechanism so that management can have control of the firm without holding a large proportion of the company. Some people see that as a negative corporate governance, and therefore or underperform relative to those that only have one class of shares. So let me write dual class shares as another example. In any case, you can look into this yourself if you want to know more about other so-called good governance practices. Okay, so again, we're just still talking about institutional details and going about actually holding onto the market portfolio. So 2 ways to invest in index funds. You can buy mutual funds that are so-called open-ended funds. So there's 2 types of mutual funds here. So there's a so-called open-ended funds or open-end funds, and also closed-end funds. Closed-end funds. So what that means is that for both these, so closed-end funds just means the fund issues shares like an IPO, and then they stop issuing shares, and it's really up to the investors to buy and sell from each other. Open-end funds are more popular. What they do is that they can buy and reduce the number of shares outstanding anytime, and they would calculate the return of, but you can only buy and sell these shares through the mutual fund. Okay, so that's something to emphasize here. So you're not buying and selling shares with other investors. You can only buy and sell shares with this mutual fund. So yes, you buy directly from them, and when it comes to sell, you sell it back to them. Okay, and the value of your shares are based on what's called net asset value. So net asset value is defined as total assets of a mutual fund minus its liabilities. And if you want to calculate its net asset value per share, you divide it by the shares outstanding. Okay, so the main benefits of this type of mutual fund structure is that you have so-called lower fees. But there's a cost, right? You can only buy and sell from the mutual fund, and you can only do this after a certain time period at the end of the day. So I think it's determined for the most part at 9 p.m. So there is a liquidity cost to having this kind of mutual fund structure. Alternatively, rather than invest in these, so-called open-end funds, you can invest in a exchange-traded fund. So these funds you don't buy and sell. Well, they can buy and sell on the open market as well, but you can buy and sell these shares from other investors as well. So it's listed on a stock exchange, and therefore you have more liquidity. Okay. But these are less popular than your typical mutual fund structure as listed here. All right, so let's look at the general pattern of mutual fund holdings over time. So if we look at in the US, of course, this is much different than what it's like in China and maybe even Hong Kong. If you look at the US, the pattern is that more and more people are holding onto the market portfolio through mutual funds, and less so through direct holdings themselves. So if you look at the general pattern over its history, since 1980, the direct holdings of stocks has been in decline since 1980 all the way to today. So the general pattern is quite obvious, right? It's moving down for direct holdings, but holdings onto open-ended mutual funds have increased dramatically. In fact, it's probably closer to 40% today. ETFs is less popular, but it's growing in popularity as we speak. And so what does that mean about what does that mean in terms of passive versus active mutual funds? So of course, as I already stated, mutual funds, there's 2 types. There's actively managed mutual funds, but there's also passively managed mutual funds. And while these investors are converting from direct holdings to indirect holdings through mutual funds, are they still opting for active management over passive management? And again, based on history, we see that in the beginning, it seems like people are moving their money into actively managed mutual funds, but over time, they're slowly moving their funds to mutual funds that are more passive. And as you can see, this is a time series plot of fraction of U.S. equity funds invested in index funds. So again, index funds is the same as passive mutual funds. And over time, it grew from 2% in the early 90s all the way to 12% in the mid 2000s. So today it's probably closer to 40%. Okay, so almost half of all money in mutual funds are in passively managed mutual funds. Okay, so we can further decompose this passive equity ownership into different institutions. So what kind of institutions are actually putting money into index funds? Within the US, we see that it's quite popular among workers in general. All right, institutions that have employees in general. So for the public industry, so this public is government employees. Basically, half of public companies that have pension funds, for example, or retirement funds, they put half of it in passively managed funds. Other types of retirement funds include defined benefits plans. So DC stands for defined benefits, or sorry, defined contribution. DC is defined contribution. So this is where you have employer-employee invest together. So employers would match a certain percentage of investments in their retirement fund. So employer-employee matched. And we see that nearly 30% of defined contribution plans are invested in passively managed funds. Same thing for defined benefits plans. So DB stands for defined benefits. So the difference between defined benefits and defined contribution is that defined benefits plans are typically fixed income, meaning it's like a salary after you retire, and you get paid a fixed amount from retirement all the way to your death. Benefits. Okay. So, for example, this is a pension fund. That's what. All right. And lastly, we have nonprofits, and we see that the trend for nonprofits investing in passively active funds has also been increasing from around 10% in the late 80s all the way to, again, roughly a third of their portfolio invested in index funds. So the question you should be asking yourself, with so many people investing in index funds, are these index funds actually performing better or worse than actively managed funds? So there is a bit of a paradox, as I will explain later to you when we try to evaluate the how valid the CAPM is. All right, so that's exactly what we're going to do. We're going to try to evaluate market efficiency and alpha. So in general, there is a paradox in the literature empirically. If you look at the stock market itself and you try to construct portfolios and investment strategies historically, you'll see that there is tremendous amount of inefficiencies. For example, for several papers, maybe 10 years ago or 20 years ago, a lot of these papers have found that momentum strategy generated positive, large values for alpha. Okay, and so again, remember, a large alpha means that the CAPM is not very good at explaining the variations of performance of the stock market or a particular stock. But at the same time, if you look at mutual fund performance, you'll see that index funds at the same time outperform those actively managed funds. And again, these actively managed funds can use those momentum strategies, but at the end of the day, they tend to underperform compared to the index funds. So there's a paradox. There's a mixture of of evidence that supports the CAPM and a amount of evidence that undermines the CAPM. But it's really, at the end of the day, we have to find some balance to accommodate both sides. So CAPM is good to a certain extent, and we can try to augment it to be more robust. Okay, that's what we have to do as practitioners. All right, so let's talk about how to go about evaluating the performance of CAPM. So if you recall the CAPM, it looks like the following equation. CAPM basically states that expected return of any asset is equal to the risk-free rate plus exposure to the risk factor, the market excess return, right? That is our single risk factor. And what does it mean to actually, for example, outperform the CAPM? And what I posed for you here is trying to explain to you that simply having a higher beta doesn't mean that you are beating the market. So we can obviously get a beta of 2 quite easily by conducting the following strategy. We can do this. We can form a portfolio with 200% of our money invested in the market portfolio, but we would borrow negative 100% of our fund at the risk-free rate, and we will get a beta of 2. And we can show this to you quite easily. So remember what I said. Our portfolio is 200% in the market return, okay? And we're going to short the risk-free rate at 100%. So that's why it's a minus RF. So if we take the expectation of RP, that's going to be 2 times the expectation of the market return minus RF. There's no expectation for RF because RF is a constant, it's deterministic. And we can actually make this equation look like the CAPM by doing some simple algebra. So we can rewrite this equation by subtracting and adding the risk-free rate to this term here. So let's do that. We have 2 times ERM minus RF plus RF, and then minus RF. And let's factor out. Let's realize that we can rearrange this by grouping some terms. So you can get 2 times ERM minus RF plus plus RF. Okay, the reason is plus because we distribute the 2, and that's how you get the plus sign, right? And then there's a minus here. All right, so then we have our CAPM, right? This would be our beta, right? This is our beta P, and this is now looking a lot like, or looks precisely like our CAPM equation. Or more precisely, it looks like this equation here. And the question I pose to you is, did we just beat the market? And the answer is no, as I already stated in the beginning. No. The reason is because the CAPM model is not showing whether or not we are beating the market. It's simply showing the trade-off between risk and return. So higher beta just means we have higher risk. And therefore, with higher risk, we have to require a higher return. Okay, that's what CAPM is telling us. There is a relationship through beta that explains the risk and return trade-off. In other words, we are still working within CAPM. So how do we go about estimating how well CAPM fits historical data? And we can do this through, most simply, using ordinary least squares regression. So this is our, so let me explain to you what that looks like. So recall from your introduction to regressions analysis, our OLS, or ordinary least squares model, looks like the following for CAPM. We regress excess returns of the stock on the market risk premium. So that's RM minus RF. Beta is our coefficient that we're going to estimate, and then we allow a constant term, right? Like all regressions. Or that just means we have a column of ones, right, as our explanatory variables. And then we have an error term. So of course, it will look like our CAPM model if we move this term to the right-hand side, but we're moving it to the left-hand side so that our expression looks like a regression model. Okay, so in your regression model, this would be our y, right? And this would be our x term, and then we have a constant term, and then we have an error term. So remember, when we do our regressions, we have to assume certain error structure of our epsilon here. So this is our error term. We're assuming that our error term has a mean of 0, and also that the variance of the error term is going to be some constant sigma square. So it doesn't vary over time. And we also are assuming that the covariance of the error term with other explanatory variables is 0. Otherwise, there is going to be bias. Okay, so that's without going too deep into the model, but that's the setup of the problem. So once we have our CAPM model written in a ordinary least squares format, we can go and then run the regression and estimate our beta. Okay, and we typically estimate it with you typically write the estimated value with a hat, right? So beta hat is our estimated beta that we get from historical stock returns. So how do we go about evaluating CAPM in this framework? It's quite simple. We look at the constant term. So if CAPM is accurate, our alpha should be very, very close to 0. Okay, so if it's okay for alpha to be, some positive term, that's okay. But as long as it's on average 0, no different, statistically different from 0, then we would say CAPM is quite accurate. But if we get large deviations in our model, we should get alpha that's quite large, right, statistically speaking. So we can calculate this alpha by simply subtracting realized return, the mean realized return, from our predicted return based on our CAPM, right? So alpha hat is not true alpha, but it's the alpha that's predicted from our ordinary least squares model is equal to the average realized return, excess return of our asset, minus the predicted value coming from CAPM. So beta hat is our predicted beta that we estimated through ordinary least squares, and we multiplied by our average market excess return, and we should get, so I'm putting a bar to indicate average that's estimated from data. Okay, so if I put expectations in bracket, that would mean that it's the truly observable mean, but we don't. Okay, we don't know the true value. We're always estimating. So our estimated return minus our benchmark, which looks like this is the following, right? This is what it is, minus our F. And there we go. Okay, so this is our predicted, right? Predicted return, predicted by CAPM. And this is our realized return. And this equation, therefore, corresponds with this equation here, right? So if you want to write this in terms of our econometrics ordinary least squares syntax, it would look like the following. We have alpha hat equals to y bar minus beta hat x, right? X bar is our observed excess market return, and our y bar is our observed realized mean return of our asset. Okay, and therefore alpha is anything that's not explained by our CAPM model, CAPM, and so if we have a positive alpha, it means that we can actually make some money, right, by buying this asset. Okay, whereas a negative alpha means we can make money by selling the asset. All right, so let's look at this graphically. We've actually seen this before. What does a positive or negative alpha mean, and how we can actually make money off of it if CAPM is actually the true model of our stock returns. Okay, so let's look at alpha and our portfolio frontier. Okay, so let's suppose that, in order to kind of understand positive and negative alpha, let's think about the scenario in which we have news coming out that the market, if market prices are unchanged, suppose market didn't react to it yet, the returns on GM and ExxonMobil increases and IBM and Anheuser-Busch decreases. Okay, so this is a change in beliefs. We're just assuming that it's totally random. It's a shock to beliefs. Everybody just suddenly had a different opinion about GM and IBM. So what you should note is that GM's return has gone up, and so has ExxonMobil, but the return for IBM has gone down, and so has Anheuser-Busch. So IBM, again, is the International Business Machines. They used to make laptop computers, but they're more focused on services, IT services now. GM makes cars. ExxonMobil exports or manufactures oil, and Anheuser-Busch makes beer. Okay, so this is what it looks like on our frontier. So as you can see, we ExxonMobil and GM are moving actually towards the frontier. So they're actually becoming more risk efficient given their risk, whereas IBM and Anheuser-Busch are becoming less. The returns are lower. So that means we should see the portfolio the market portfolio adjusting more towards ExxonMobil and GM and away from IBM and Anheuser-Busch. And just to emphasize, these are not coming from fundamentals. This is kind of a change in belief. So this is exogenous, meaning it's coming from outside the model. We're not talking about undervaluation or overvaluation. It's just a sudden change in beliefs. Okay, so what does this look like on the securities market line, given this sudden change in beliefs? So this is very similar to a graph you saw last week. So if GM and ExxonMobil have suddenly higher returns, then on the SML line they're going to deviate away from it by moving above the line. Right? So this is GM, and again, when it's above the SML line, it means that these stocks have suddenly become undervalued. And so this difference between what's predicted by the SML line versus what's actually based on your beliefs is called alpha. So this has positive alpha here, and this is positive alpha here. Conversely, IBM and Anheuser-Busch that have now lower returns based on our beliefs are going to have negative alpha. They're going to be below the SML line. And these stocks have now become overvalued. So let me reiterate what undervalued, overvalued means. Undervalued means that prices are too low. To justify the higher returns, right, and beliefs. And so if they're undervalued, and again, the logic here is that because these assets are becoming more risk efficient, we expect the market portfolio to shift towards these stocks now. That means everybody should be buying more of these stocks, and that's going to bid up the price. And as we bid up the price, GM and ExxonMobil is going to move back towards the SML line sometimes in the future because, again, people are buying these assets, readjusting the portfolio into becoming more risk efficient. And same thing for IBM and Anheuser-Busch. It's overvalued because the price is too high. So overvalued means prices are too high for lower returns. And therefore, we expect people to sell and people to buy. So the logic here, again, is people are going to sell the stock, the prices are going to drop because, again, the market portfolio is becoming always more efficient, so they're going to sell off IBM. And by doing so, prices will drop, returns will drop, and therefore this IBM is going to move back towards the line again. Okay, so that's what the effect on trade means. Okay, so just to emphasize, make sure you read the the legend, and then it should make sense. Okay, if you're still confused about why GM and ExxonMobil are considered undervalued and why IBM and Anheuser-Busch are considered overvalued, and then because of this overvaluation, undervaluation, the market is going to rebalance itself towards the undervalued stocks, and that's going to push up the price of GM and ExxonMobil, and therefore the returns is going to drop, right? That's why it moves back towards the line. Same thing for same logic for IBM and Anheuser-Busch. Because they are below the line, that means that the prices are too high for its returns. And again, the portfolio is always efficient. The market portfolio is always efficient, and in its rebalancing, it's going to liquidate IBM and Anheuser-Busch. Selling the IBM and Anheuser-Busch is going to lower the prices, and therefore the returns will increase back to the predicted line by CAPM. Okay, so selling the price means selling an asset is going to lower the price, and buying the asset is going to increase the price. So that's the mechanism here. All right, so now we kind of know how to go about evaluating CAPM. We evaluated through alpha. So if we see portfolios that generates alpha above and beyond the market security line, then a security market line, then we know that CAPM is likely not capturing the actual structure of risk and return relationship. All right, so let's emphasize again the assumptions of CAPM. So the assumptions of CAPM relies on a basically hidden assumption that the markets are efficient, in the sense that any new information is captured immediately, instantaneously, and in that sense, everybody should have the same information set. So if that's true, then we should expect CAPM to hold. But of course, that's not going to be true if you think about it. There's a lot of cases in which people have insider information, and with insider information, they know precisely which companies are overvalued or undervalued, and they can make superior trades that beats the CAPM benchmark. So that's kind of the idea here. We start with a benchmark and figure out how we can deviate away from this benchmark. So it's, despite being overly strong in their assumptions, it gives you an idea of the channel through which CAPM can break. Okay, so let me reiterate what CAPM assumes. CAPM assumes that markets are efficient, and that means that securities will be fairly priced given publicly available information, as stated in bold here. And the rationale is the rationale is the following. We assume investors are very competitive. They're always reading the news. They incorporate information essentially instantaneously. And therefore, if that's true, prices should reflect new information instantaneously as well. So that means we shouldn't see any sort of delay. We shouldn't see any overreaction or underreaction to certain news. The market will just jump from one point to another given new information being released into the system. Okay, that's what efficient market hypothesis is. And the reason we start with this benchmark with market efficiency, again, is so that we can identify a channel through which CAPM can break. And that's through the information channel. So despite being overly making some very, very strong assumptions, it's a good way to kind of think about how CAPM can break. So let's go deeper into this market efficiency definition. So if in your investments class, I hope you've talked about this, but let's review a bit. So there are classic definitions of market efficiency by these papers by Eugene Fama and Jensen. Fama first brings it up in 1970. That states that market is efficient if prices fully reflect all available information. So it's important to note here what all available information means here. It means both public and private. Okay, so in other words, everyone has the same information set. In that sense, CAPM is is great. It should explain everything. Jensen kind of clarifies it even more in an empirical sense. Jensen states that market is efficient if you can't make any excess profits by trading on all available information, right? So that includes, stuff like technical analysis, trend analysis, any sort of momentum style trading that shouldn't generate any sort of money. Okay, so this is the theory, this Fama paper, and this gives you the empirical tests to evaluate it. So the idea is the following. In order to confirm that CAPM is true, we can evaluate it from the information channel by showing that it's basically impossible to generate excess returns above and beyond the benchmark consistently. So we can evaluate this in two ways. We can actually conduct back testing by looking at historical data and making hypothetical trades. If those trades turn out to generate positive alpha consistently, then we can say that CAPM is wrong or broken. Another way to look at this can be looking at comparing funds' performance. We can look at funds that basically just track the market and compare their performance to funds that pick and choose the stocks they want to hold. And that's where the paradox arises, which is what I stated earlier in this lecture. So we'll evaluate CAPM in those two dimensions, and it's up to you to either look into the details and to see what you really believe. All right, so a little bit more information on the efficiency here. So we have 3 forms of efficiency. So what we've been talking about so far is what in CAPM is what's called the strong form efficiency. Okay, so strong form efficiency basically states that security prices reflect all information. Okay, so this is where we get CAPM. We have no insider information, and no matter what, on average, our alpha from our model that we estimate using ordinary least squares should be 0. Of course, that's not true empirically. As you all know, it's possible, such as some major financial institutions, to know more about the market than others, and therefore they can use that information to generate superior returns. In that case, we have to have a weaker definition of information, right? We have here the semi-strong form efficiency, which states that security prices reflect all publicly information. So that allows for institutions such as banks and investment funds to have private information, but we can still say that the market is still good at incorporating public information, and therefore people shouldn't be able to make money by reading the news. Okay, so to summarize what semi-strong form efficiency says, semi-strong form efficiency states that investors on average can't make money by reading the Wall Street Journal, okay, for example, or the Financial Times. So reading the Wall Street Journal doesn't work. But it's possible to generate positive alpha if you have private or superior information. And lastly, we have weak form efficiency. So weak form efficiency states that, okay, maybe the market is not so good at incorporating news instantaneously. It may take some time, but it's possible to still make some money by being a leader, right? To read the news first. So that's still positive alpha. So if you're the first one to capture the news, to read the news, you can still make the trade and still generate alpha. But what weak form efficiency states is that past information is no longer a good trading strategy. So in other words, technical analysis doesn't work. Okay, so we can definitely evaluate these assumptions empirically, right? For strong form efficiency, in order to evaluate this, we can simply look at price reactions to news, right? Such as earnings announcements or mergers and acquisitions. If we see that the market either is, overreacts or underreacts, then semi-strong form efficiency is definitely violated, right? Because all information isn't captured instantaneously. There are some people who can see process the news faster, and they can generate positive alpha. We can also evaluate weak form efficiency. Again, if momentum trades, which is purely based on past performance, generates positive alpha, then weak form efficiency is also violated. Okay, so let's summarize what I just said. So if there is a positive alpha investment available, it means that prices do not fully reflect all information. And we can definitely test that using historical data. Positive alpha means that the market is not efficient and either requires barriers to entry into the stock market. So this is kind of like a technical detail, like there's transaction costs. Maybe it's hard to get information instantaneously. There may be liquidity issues, but anyways, that's kind of beyond this course and more of a microstructure question. And but more importantly, there's an implication that our CAPM model does not describe all undiversifiable risk in the economy, which means that the model is therefore not true, right? That's something we can't test, but we can definitely evaluate this statement based on historical data, as I described earlier. So let's look at some data then. So the most basic idea to evaluate market efficiency is simply look at whether or not there is some momentum strategy that you can create, right? Momentum is purely based on past returns and doesn't require you to read the news consistently every day. You just have to be able to see trends. And we can do this by simply calculating the serial correlation or correlation between prices today and in the past, right? Or yesterday and the future. So let's look at the following stock predictability over several intervals of time. So we can look at short run predictability. So short run predictability just means daily. Can we predict stocks tomorrow based on yesterday's returns? Medium run predictability can look at a period of months, and long run predictability can look at over a period of years. For the most part, to summarize what I'm going to present to you, short run predictability is very difficult. It's very volatile. So in that sense, it seems that the market is quite efficient. You can't predict tomorrow's stock returns, and therefore alpha should be zero in that way of argument. But if you look at longer periods of time, if you look at the median run predictions of earnings, for example, earnings announcements or mergers and acquisitions announcement, you'll see that stock returns has a long underreaction in response to these announcements. For long run predictability, similarly, we see that momentum strategies, where we look at past returns and past losers over several years and construct a portfolio trading strategy that way, we see that we can definitely generate some alpha, at least within the periods that's analyzed in the literature so far. So let's look at short run predictability. So Fama was among the first to look at stock run predictability in the past, and what he did is to, again, simply look at returns of stocks today versus stocks lagged one period. So here we show 1 day change in prices, 4-day changes in prices, 9-day change in prices, 16 days in prices. And serial correlation just means, another way of saying serial correlation is autocorrelation. And that's just looking at the correlation coefficient between stock prices today and stock prices yesterday. Okay, so if there is a strong correlation between today's returns and yesterday's returns, then I simply have to buy stocks that are going up. that went up in the past and sell stocks going down in the past, right? And then I can generate positive returns or excess returns. And for the most part, based on data up to 1965 at least, we see that the serial correlation is very, very close to zero. So based on this very, very simple statistical analysis, we see that markets, at least on the surface, appears quite efficient. Okay, so let me emphasize the rho here is my correlation coefficient. So rho is a covariance of RT minus 1, and then the standard deviation of RT and standard deviation RT minus 1. So RT minus 1 just means the stock returns lagged by one period. So in this case, 1 day. Of course, we can plot these returns in a graph, right? So again, we should see predictability if there's any sort of linear pattern that arises from comparing 1 day's return with yesterday's return. In this slide here, what we're showing here is returns on day t plus 1. So this is percent return, and the return on day t. Okay, so we're comparing t versus t plus 1. If there is any sort of predictability, we should see some linear relationship. But as you can see, based on these 4 plots for Microsoft, BP, British Petroleum, Sony, and Philips Electronics, there is no linear pattern that arises, whether it's positive or negative, right? I can draw any line here, and it looks like it's a possible trend line, right? Could be, none of these look like they have any sort of linear trend. It looks like just a shotgun spread. So based on short-run returns, it looks like markets is quite efficient. However, if you expand your trading horizons beyond a day, the story becomes quite different. So I present to you here with 2 sets of papers. We have Jagadish and Titman 1993, which looks at serial correlation of returns over 6 to 12 months. And we look at DeBon and Thaler 1985, which looks at trading strategy over periods of 3 years. They get contradictory results. So what Jagadish and Titman did, it conducts a trading strategy that buys stocks that have high returns over the last 12 months, and they sell stocks that have low returns over the last 12 months. So again, a momentum strategy, buying winners and selling losers. And they find that their alpha has 12%, have an alpha of 12% over their investment period of from 1965 to 1989. But we find a contradictory result by DeBon and Thaler, and they do the same strategy, but for a period of 3 years, and they find that the losers actually outperform the winners. But the point here is that the pattern suggests a different story when you increase your investment horizon from just a daily to over months and potentially a few years. And the predictability of stocks, the fact that stocks become predictable, means that for some institutions, such as banks, investment funds, hedge funds, mutual funds, they can generate consistent alpha that beats the benchmark of CAPM. And that means either they have private information or our model is essentially not true, right? It's not accurate to reflect the realities. All right, so that's just based on historical looking at historical performance, right? We're just back testing our model to see if we can construct portfolios that beat CAPM, right? And for these cases, it seems so, right? If you believe in Jagadish and Titman, you can buy winners and sell losers and generate positive alpha. For DeBon and Thaler, given their strategy of over 3 years, right, performance 3 years, you can buy losers and sell winners. In either case, you can beat the CAPM and therefore generate statistically significant positive alpha. All right, so rather than backtesting trading strategies, what you could also do is evaluate events and look at stock market reactions and how whether or not stock market incorporates information as efficiently as we claim it to be, right? And remember, efficient markets captures information instantaneously, and therefore, if there is any sort of if there's any sort of change that should happen as a result of information release, it should change the stock in a discontinuous manner, meaning it should be a sudden jump. But if there's any sort of slow, delayed reaction or overreaction, then that means that either the market is irrational, meaning people are overly enthusiastic about something that shouldn't be too exciting, or they're very slow in processing and understanding information. In both cases, so long as you are a front runner, the first one to incorporate the information or to read the information, you can beat the market. Okay, so let me explain to you visually what I mean with this graph here. So if you look at this graph, time zero is an event in which information is released. So this is what this zero means. Time zero is the time or the date in which a firm announces their earnings, or they announce an acquisition of a company, or the hiring of a new CEO, right? These are all events that could potentially change future growth of a company, and it requires the stock market or investors to incorporate that information so that they can figure out if the firm is overvalued or undervalued. So let me draw a vertical line here. So if we have efficient markets and this information is exogenous, meaning it's unpredictable, you can't foresee this announcement of the information, then the market should react in a discontinuous manner, meaning that the stock price should jump immediately once the stock price has been, the information has been announced. So that's what efficient market reaction predicts: a sharp discontinuous jump in stock price. If there is, again, if we have efficient markets, if the market is efficient at incorporating and processing the information. But if we have inefficient markets, then we can see that then it's possible for some institutions, some firms, some mutual funds to be better at processing information than others, and therefore be able to generate positive alpha. So if we have a slow reaction in which the market is inefficient and people have different skills and evaluating information, then it's possible that the stock price has a slow evolution over a long period of time, and that is shown in this dotted line here, right? The stock price doesn't jump immediately. In fact, the stock slowly trails all the way up to its intended target here, right? It takes a while. So in this case, it could take 8 days, right? In that case, so long as you are better than others at reading the tea leaves or reading the information, then you can generate positive alpha. Alternatively, it's also possible to kind of evaluate information or generate positive alpha if you predict that there's going to be an overreaction. So if you think that there's some degree of over enthusiasm for a news event, then you can expect the stock price to overjump. And if you know that it overjumped, you can sell short, right? When it jumps to a level above and beyond the implied stock price based on the information released to the public. So that's reflected by this dotted line here. So in this case, we have the stock price jump too high, right? In this case, jumping to $220. If you are smart and good at processing information, you would know that the stock price overjumped. You would sell at this point here and then buy back once it converges onto the true value. So at the end of the day, it really depends on whether or not you believe there are some people at receiving the information and processing the information better than others. If that's true, then you can definitely generate positive alpha so long as you are a front runner and accurately capturing the true value of the firm once receiving the information. So this is a theoretical. This is what we predict, right? If stock market is efficient, then the stock price should jump instantaneously upon release of public information. Sorry, of new information to the public. But if you believe that there's some information frictions, either through people are just dumb in general, or there's overexcitement over something, over some event, then you can definitely generate alpha if you are better than others at accurately incorporating that information into the stock price to get the true valuation of the firm post-event. So let's look at first takeover announcement of event studies. So we're going to look at time zero in which a firm is going to buy another firm. We're going to look at firms that are going to be bought, okay? Firms that are going to be acquired. So this graph is from a research paper by Bradley, Desai, and Kim, 1983. This looks at the firm that will be bought. They are publicly traded. And of course, these announcements are meaning the intention of buying, but doesn't necessarily mean that the acquisition will take place. The reason is because there are several reasons. There are several barriers that can prevent a firm to be bought, such as national security. For example, if a foreign firm wants to buy a military firm in the U.S. that makes weapons and stuff, that's definitely going to be blocked by the government, and therefore that takeover is not going to go through. Other major reasons for why a takeover might go through is because it's anti-competitive. So if some firm buys another firm, but overall it increases prices above and beyond that hurts consumer welfare, then that's going to be blocked by the government as well. So that's why some firms are not going to be taken over. If we believe the market is efficient, then the market should know precisely whether or not firms should be taken over based on an information release. So based on this graph, it definitely seems that the market is not efficient. So in the first place, for firms that are not taken over eventually, there is definitely an overreaction. So if you are a firm or trader, investor that knows that this firm is not going to be taken over for sure, you can definitely just sell at the overreaction and just buy your shares back when the takeover eventually fails, right? So let's just say this point is when the firm is taken over, and these other firms are eventually bought. So firms that are eventually bought is this light blue line. So again, it looks like there is a slow reaction because there is a positive trend line here, right? So here we have an overreaction, and here we have an underreaction. Sorry, it should be here, underreaction. So based on this graph, it indeed seems like the market is inefficient. It's not able to fully understand, in this case, fully know whether or not a firm will be taken over at the time of announcement to buy a firm. In the case in which firms that are subsequently taking over, there's still a little bit uncertainty about whether or not that is true. For firms that are not taken over, there seems to be a pattern of overreaction, which is what we see here, right? There is an overreaction where everybody seems that believe that, oh, this firm is definitely going to be taken over sometime in the future. But as the market processes the information, the stock reverts back to its original value. That's why it goes back to zero. So if you are a front runner in processing and evaluating the information being announced, you can definitely beat the market. And another thing to note here is that there seems to be some degree of leakage of private information, right? So again, maybe not, this is again a demonstration that some people definitely has private information. So another layer of market inefficiency because people have private information, and they're definitely acting on it before the announcement of the takeover. All right, so that's takeover announcements. Now we can look at something that's just pure information and nothing to do with transactions. So let's look at TV personalities that basically pitch stocks to viewers. So in the US, we have a TV personality called Jim Cramer on CNBC or MSNBC. And what he does is basically just pitches stocks to buy and sell. And a lot of times he just chooses a stock without any sort of information to back up. He just thinks that a certain stock is undervalued. And in both cases, we see that there is some degree of market inefficiency. So in this case, we see that there is some difference between the initial jump to what the actual value is in the future, right? So there is, again, some underreaction. And in the case in which Jim Cramer proposes to buy a stock when there's no news, there's a definite overreaction, right? This is totally unwarranted returns. Overreaction. And slowly downward to should be 0%. So again, based on just pure information, it seems like Jim Cramer is just creating noise, right? And the market can't differentiate between correct information that's based on news and completely no information that's just his speculation. So another piece to add to your evidence that the market is not efficient. All right. And the last thing I want to talk about, when we just from a purely stock returns perspective, is earnings announcements. So as I mentioned, another key event that many people pay attention to is when firms announce their earnings performance relative to what the market is anticipating. Okay. So let me explain to you what's being calculated here. This is the cumulative return from the day in which an earnings announcement occurs. So earnings announcement occurs at time 0. This is when it's announced. But as you can see, there are there are several things that point to inefficient markets here. One is information leakage, which means, again, different information sets. People are definitely already reacting to information that's not privy to them yet, should not be privy to them yet. And then we see a drift, either in the positive or the negative. Okay, so these lines here means that they beat their earnings benchmark, and but that information is not fully captured until 55 days later after the announcement. Same thing for the negative, right? There seems to be a reaction for firms that missed their earnings benchmark, but that's not fully realized until more than 55 days after. Okay, so what this tells us is that there is a strong delay no matter what, right? Whether or not they beat their earnings or they earnings target, or they underperform relative to their earnings target. So very delayed reaction with regards to earnings announcements. So another evidence that market is not efficient in the information sense. And in fact, if we look at the information leakage, so let's kind of go back further than 5 days. We can go back further to 60 days. And we can already see that there are people with superior knowledge beforehand and are already acting upon that information out 60 days before the announcement, which is here. Okay, so private versus public information. So again, that means violates market efficiency. And again, we have these positive and negative trends, which means delayed reaction again violates market efficiency assumption. All right, so that's one perspective. Okay, so we're analyzing so far, looking at how well the stock market incorporates new information releases. And this is, again, simply looking at cumulative returns starting from the pre-announcement period. Another way to look to kind of evaluate CAPM and market efficiency is to look at fund performances themselves. So rather than look at stock price reactions, we can look at fund performances. Okay. So the idea here to evaluate CAPM is to compare actively managed funds to passive or index mutual funds. Okay, so if CAPM is true and if markets are efficient, then prices should always reflect those information, right? And that's coming from those accounting data that you've been looking at, and also the earnings or income statements that you've also been looking at. So if all those information are captured, then the market is efficient. Then simply holding the market should give you, the best trade-off between risk and return. And but if you believe in this superior skill story, then you expect that some actively managed funds should be able to generate positive alphas. And what we can do is we can compare the performance of these actively managed funds, their alpha, and compare those passively managed funds and look at their alpha. So let's do that for now. So let's look at the most basic comparison, which is we're just looking at raw returns of mutual funds, active mutual funds versus the mutual funds that simply track the S&P 500. So this is so these are bar plots, but each plot is a year, and the green plot represents active mutual funds. So that means they pick and choose their own stock. They don't track an index. And the market return is just the raw return, the S&P 500 index. So that's the red bars, and the green bars are active mutual funds. So as you can see, since probably 1970s to today, we see that the market return consistently outperforms active mutual funds. So anytime the red bar exceeds the green bar, it means that the average return of the index is greater than the performance of the active funds. Okay, so this is net of fees, okay, just to make sure that the returns are comparable. What you should notice may be that in these good years, S&P 500 it's outperforming, but they are not so good. They're probably better hedged in the downturns, which seems to be true. So if you look at the financial crisis, S&P 500 definitely dropped a lot, but they seem to be a little bit better hedged against downside. But they're definitely not efficiently exposed to the upside. Same thing for the 9/11, right? Okay, so to kind of be more robust about this, we can look at their alpha, right, rather than the raw returns. So let's move on to their alpha. So this paper by Kosowski, Timmerman, Wimmers, and White, 2006, they look at alphas across all funds. So alpha just means we have already adjusted for the benchmark of CAPM, okay, so or the excess return premium, okay. And as you can see, across all active fund strategies, so aggressive growth means that they're only targeting perhaps small caps and tech firms. Growth, again, probably a little bit more diversified. Growth and income, some small cap funds, and maybe high-paying dividend, blue chip stocks. Balance just means they may have other assets in their portfolio, and all means all mutual funds, okay? And we see that their alpha is consistently negative. Okay, negative 0.4% for aggressive growth, balanced their income even worse, and on average, it's quite bad, okay? Some may say, okay, maybe on average, firms are hiring bad people. That's something you may argue. So let's look at so-called star performer fund managers and see if they really they actually do have skill in bringing about superior or statistically significant alpha. So that's exactly what this paper evaluates. So Buss, Goyal, and Wahal, 2010, they look at star managers that have that are attributed for generating large alphas for the funds. And now we look at when they move from one fund to the other. Okay, so we're looking at star fund managers, and we identify them based on past performance. So based on this graph, before they are hired at another fund, we look at their performance in the past, and that's going back here. So the x-axis here is the time relative to the hiring date to a new fund. So -1 is 1 year before moving, 2 years, -2 is 2 years before, and so forth. And we see for these star managers, they are generating alpha quite consistently, right? 3% through 4%. But once they move to a new job, we see that their performance is unremarkable, right? 0.5%, maybe not even statistically significant. So it seems like the explanation they give in this paper is that for these fund managers, these star fund managers, they were managing small funds, right? So their asset under management is quite limited. But once they transition to larger funds, their strategies are no longer scalable. That means that any sort of superior edge they may have is quickly understood by the market, and all traders kind of figured it out. And so their edge becomes well known once they scale their portfolio. So in other words, this supports the thesis that the markets are quite efficient at learning about fund managers' strategies. At learning fund manager strategy. Okay, so different story, but it gives you a different perspective about the market efficiency. So it seems like, again, if we look at purely event-driven stock returns, the market's quite inefficient because they're slow. Sometimes there's an overreaction, sometimes there's a delay. But when we look at the performance at the institutional level, it seems that it's very, very difficult to generate consistent alpha. And even when we look at star fund manager performers, they can't consistently produce superior alpha, right? And it seems, again, that once you scale certain strategies, especially from the small fund to a large fund, that strategy is learned quite quickly by the participants in the stock market. All right, so if you're not convinced about this fund manager alpha story, you can just look at hedge funds directly. So hedge funds typically are, they are private, they have secret information, and they may have their connections that's not widely available to mutual fund managers, and therefore they should generate superior alpha, right? But if we look at them in aggregate, that's definitely not true. And so that's what Abbottson, Chen, and Drew 2011 observe as well. So if we look at the x-axis, which is the years, so 1998 all the way to 2009, and our y-axis is our returns. The alpha that's generated by hedge funds is the gray line. You see that the hedge fund alpha is always, for the most part, smaller than the systematic beta return that's produced by CAPM, or some version of CAPM. All right, so this is the systematic beta, and this is the alpha. Beta return. All right, so to summarize, it depends. To summarize, whether or not the stock market is efficient at incorporating information is a hotly debated topic. There's always people coming up with interesting stories to explain why, whether or not the market is efficient. And I've presented you a few key papers that try to show either that the market is really inefficient at incorporating information, and also some supporting evidence that the market is indeed efficient, because consistently generating alpha, positive alpha, is very, very difficult. So if you look at simply events, reaction of the stock market to financial transactions such as mergers and acquisitions, earnings announcement, it seems like the stock market is quite dumb, right? It's hard. Sometimes it overreacts to no news. Sometimes it overreacts to transactions that will never be completed in the future. But we also get cases in which the stock market is uncertain and having trouble processing information until far out into the future. So nothing shows that the market has a discontinuous jump at time zero. That's very rare cases. On the other hand, if we look at the performance of institutional investors such as active mutual fund managers, hedge fund managers, star fund performers, we see that their performance are basically, it's difficult to sustain their performance. So if we look at simply looking at the alphas of actively managed mutual funds, they're all negative across the board, no matter what strategy you're using. For star managers, we see that their strategies are not transferable or scalable, right? Meaning that the market is quite smart in incorporating and learning about fund strategies. And lastly, if you look at those specialty hedge funds that have secret information and so forth, they still, on average, underperform the market. All right. Last topic I want to talk about today is multi-factor models of risk and return. So despite all the tests that I talk about, it's still possible that it's not an information story. It's still possible that the CAPM that we wrote down, the theory is simply wrong. And many finance practitioners, finance researchers in academia, they try to kind of come up with a more complicated model to actually explain asset returns. And so that's what this next topic is. We're introducing additional risk factors to make our CAPM model more robust and to show that basically making less likely that a fund manager is underperforming or overperforming to the correct benchmark. So this augmented CAPM is just going to be a new benchmark that people have to beat. Okay, so to summarize, CAPM states that the only risk that investors care about is the market risk, or the market excess return. And therefore, CAPM is a single factor model of risk and return. This requires extreme assumptions, and maybe investors care more about than just market risk. And for example, maybe variance is not the only thing we care about. We may care about other things such as skewness or other moments of a distribution. But in any case, we can augment this model by incorporating and identifying factors that investors may also care about, such as momentum and size and value, which I will demonstrate to you what that looks like graphically, and also what that looks like for the model itself. Okay, so if we want to augment the CAPM, we simply introduce new portfolio factors essentially into the equation. So if we look at the following expression here, if our model is simply a single factor model, then we would only have this CAPM factor, or the market risk factor. If we want to augment this model with other factors that investors care about, then we just simply incorporate it in linearly as another coefficient that we have to estimate through regression analysis. So this other portfolio characteristic we have to come up with ourselves, and there's literally almost probably thousands of papers that try to come up with new risk factors that people claim investors care about. And so we'll just be talking about a few of them here. So namely the ones proposed by Fama and French, and also by Carhart, which is the momentum factor. All right, so let's talk about the factors introduced by Fama and French. So Fama and French comes up with the three-factor model, okay, which means that in addition to the risk factor, we have also size, firm size, and also value, or based on market to book ratio. So if you look at so let me show you what this is. So in addition to the market risk factor, we have a size effect. So that's just market capitalization. The argument here is that small firms may be undervalued, and so we suspect that small firms to generate excess returns above and beyond predicted by the security markets line. So as you can see, if we look at this legend here, small firms are red, whereas big firms are blue. And if we sort these firms 1, 2, 3 through decile portfolios, what we can do is we can buy or go long on small firms and then sell big firms. Sell or short. Okay, so we construct a portfolio in which we buy small and sell sell big firms. And in doing so, we see that these portfolios would generate, or these small firms would generate positive alphas. So remember, the red dots are small firms, and the blue dots are large firms. And so the smaller the firm, the more alpha that's going to be generated. And if investors care about this, they can capture this alpha by simply buying small and selling short. Remember, any dot above the security markets line means that the firm is undervalued. Okay, and Fama and French also claims that a value effect also matters as well. So value is measured by book to market ratio. So book shareholder value. So book shareholder value to market value, or book to market ratio. So let me reiterate what small versus big here. Small size is measured with market capitalization. So same thing here. What this is saying is that firms with good fundamentals, right, meaning they have large values,
may mean that they are undervalued. So what Fama and French proposes is that if investors care about this, they would buy or long firms with large book-to-market values, and short, firms with small book-to-market values. Short and sell. And so, as you can see, based on this line, it seems that firms with small, low stock price but very good fundamentals seem to be undervalued relative to what's predicted by the capital security markets line. All right, so that's how we incorporate the Fama French factors. And we can do the same for momentum. So momentum here is by Carhart. That's the third additional factor. And the same idea here is we're buying winners and selling losers. Okay, that's this return here. Buy winners, sell losers. And again, based on these graphs here, what Fama French and Carhart did is they sorted the firms into deciles. That's why it's 1 through 10. And it would sell, and they would sell for the size, it would sell the largest firm in the biggest decile, and then it would buy the smallest decile. And the opposite for the value effect, and then and something similar for the momentum strategy. Okay? So let me reiterate what these factors are. This term here is the market risk factor. This term here is a portfolio return after you long small firms and you sell big firms. So SMB stands for small minus big. And HML stands for high minus low. So high book to market means that the firm is undervalued, has good fundamentals, but it may have a small stock price, low stock price, market cap, and therefore it's undervalued, and you should go long on high book to market and sell low book to market, which may be an indication that a firm is overvalued, right? If its market cap is really big relative to its book value. And lastly, the momentum factor is if you, again, sort firms based on past winners / past performance of firms based on history, and you would basically buy past winners and sell past losers. And that return is just captured by this expression here. So then we have essentially augmented the CAPM model with 3 additional factors: beta SMB, beta HML, and beta momentum. Okay. So these factors you can actually get from Fama French website, at least SMB, HML, and MKT. All right, so I don't expect anyone to calculate the Fama French Carhart 4-factor model. This is just something you should know in the back of your head, that this is what researchers and practitioners have at their disposal to calculate the proper discount rate. In fact, I believe that most practitioners just stop at the size factor. They don't think about the market, the book to market value, or the momentum strategy, because it's just it's probably excessive for valuation purposes. But for our class, I don't need you to get SMB. That's fine, as long as you have beta MKT. That's good enough. So to wrap up, this is what we covered today. We talked about how we would go about investing in the market portfolio, and also evaluating how good CAPM is in capturing how well the CAPM is when by evaluating the assumptions that allow us to use CAPM. Okay, so we did this by looking at by comparing the performance of actively managed funds versus passively managed funds, and we also looked at stock market reactions to financial transactions and news announcements. Okay, and we discussed how we would go about estimating deviations away from CAPM through regression analysis by looking at alpha. And lastly, we talked about multi-factor models of risk, in which we augment the CAPM with 3 additional risk factors: the size factor, the value factor, and also the momentum factor. Okay, so that's it for today. If you have any more additional questions, feel free to send me an email or comment in Canvas. That's all I have for you today, and have a nice day.